Thank you, Stella. Welcome, everybody, to this evening. Hopefully, we all get a fair bit out of it. First of all, because it is a financial planning presentation, one of the most important things I need to do is go through a general warning advice. I won't read every word on there, but essentially, this is a general presentation for everybody. There is no personal advice being given. If you do have any personal questions or any issues you'd like to discuss about you individually, feel free to organise a time to catch up with me outside of this particular presentation. All right. So I suppose most of you know who I am, but the genesis of this presentation came from obviously a lot of us being in isolation due to circumstances that were totally out of our control. Now, when we all went, so that's basically all of the senior and reserves players at West Footscray. So, and also the others, anyone else who was actually involved on the day were either in full isolation or had to go and get tested. And then once they tested negative, were able to be released. So in my couple of roles I have, one I was obviously as a senior coach and having responsibility for the players, but also one of my skills is a planner and looking after people in a day-to-day in their day-to-day life financially. I came up with the idea, well, why not provide a presentation to make sure that we utilize this time that we've got, considering there is a lot of uncertainty around, and to show that things, whilst they might seem bad at the moment, there is plenty to look forward to in the future. With Victoria going into lockdown, we've expanded it out a bit, and for the first time tonight, I'm actually doing a live stream on Facebook, so that'll be interesting. And I'd also like to acknowledge the marketing team at Modoras, Stella, Elaine, and Emily, who were absolutely awesome in helping me put together this in such a short period of time. All right. So, and as Stella mentioned, please feel free to add any questions at the question and answer tab or in the chat tab down below the presentation, and we'll get to them at the end of the presentation itself. So what is financial planning? It's one of the things that's quite often misunderstood. And we talk about all of the wrong things when it comes to financial planning. Or what should we invest in? Or what should I do with this? What should I do with that? When realistically, there is a process behind financial planning that actually directs it in the right intent, in the right direction. And the most important people is you, not the financial planner, not the financial planning firm. It's you. It is, and our role as planners is making sure that our first, second, and third thing is understanding you. You, your lifestyle, your home, your career, your family, retirement, money, business, health, dreams, your community. It is absolutely critical that you are understood first. So one of the things I hope people get out of this today, even if you decide to go and speak to other planners or whatever it might be, or you just want to talk to friends or family members, the most important thing that they should be talking to you about and asking you and listening and understanding is you. All right, now here is where we really need to focus on when we're looking at anything to do with planning. Obviously, we've experienced COVID and lockdowns, the big one last year, the earlier one last year, which actually had more financial impacts. And obviously, we're still going through, and we will still be going through quite a few more over the next 12 months. How do we know and how do we prepare for these sorts of events that happen, but also keep our eye on the future? And it comes down to this: goals, understanding goals. Now, you need to be very, very clear. A lot of people come in and say, and if I'd ask them, what's their goal? It might be, say, to negatively gear a property, or it might be to, I want to start an investment portfolio, and a number of things. The problem with that is they're not actually goals. Negatively gearing a property is a combination of, there's a part strategy in there because it's a tax benefit in there, and there's also a product, which is the property. Investment portfolio, yeah, it's great, but again, all we've got there is a product. They are not goals. Goals are things such as, I'd like to be in a position to retire at the age of 55, 60 or 65, whatever it might be. And I'd like to retire on $60,000 per annum. Other goals can be things like, I'd like to buy a new house, or buy my first house. It might be something along the lines of, I've got kids and I want to make sure that when they get to secondary school age, we've got choice of schools that we can send them to. So we want to build up a bit of an education fund. It might be a new car. It might be renovations. It might be a large overseas holiday with you and the family. Not that we can actually do those at the moment, but these are goals. Now, the most important thing and they're your goals. They're not what what you think you should be doing. It's not what someone tells you should be doing. This is your goals. Now, if you've got a partner, it's about talking with your partner to make sure that you are focusing on these things together. The two most important factors in any goals is timing. When are we going to do it? And that's extended a little bit further for retirement, where it's how long it is, and that's dependent on what age you're wanting to retire at, and how much. Because once we've actually got those two things in place, as any decent planner should be able to do, we can develop strategies. Now, strategies are the ways that we achieve those goals. Products are the things that we use within the strategies to achieve the goals. But if we don't understand what the goals are, the planner or friend, family, or whoever it is you're seeking for the advice isn't focusing on the right thing. These are yours. We need to have a destination that we're trying to achieve. And it's often hard. I speak to a lot of people and they say, I don't have any goals. Well, realistically, it's too hard to think of goals because they think that once they say, I'm going to retire at 55, I have to, or I'm going to retire at 65, I have to, because that's when everyone else does. Or I'm going to buy a new house in 5 years. And if you don't do it, there's some sort of a failure. That's why when you're having your conversations and thinking about your goals, frame your thoughts into what would you like to be in a position to do? Because that frees your thoughts and removes any roadblocks about worrying about whether you have or haven't got any goals. So your current position, again, a lot of people, this is their starting point. And you can already see this is step 3. First of all, the planner needs to get and understand you. Then we need to understand what your goals are. So you've had a good conversation. Your current position is step 3 in it because that's a question of fact. What your current assets are, whether you've got trusts, companies, superannuation funds, or whatever it might be, what your cash flow looks like, both your income and expenditure. Is there any changes coming up? What your current liabilities are and what your current protection is. They're important questions of fact. And if you actually go back to what the goal setting was, again, one of the things and the simplest things to keep in mind that would have been a protection mechanism for COVID, for example, and lockdowns is I'd like to have a cash emergency fund of 5,000, 10,000, 20,000, whatever the figure is that you're comfortable with, so that if an event like this happens, you've got the money there. And you're not worried about what happens with the markets. You're not, whether it be the financial markets or whether it be the property market, it's an irrelevancy. You've actually got the money there. So again, planning builds in a lot of protection mechanisms. Understanding what your current position is just that, understanding where you are at the moment. Now, tailored solutions. I work in an industry that's 1, highly regulated, and 2, loves acronyms. This in simple English, if we were talking about it, would be a financial plan. Now, we don't use the terminology in our industry as of a financial plan because a financial plan has the same acronym as financial planning, which is FP. So you can't have the same acronym. So we've come up with this new word called a statement of advice, which gives us the acronym SOA. What do we look at? And what are we trying to do? So this is the strategies to make sure. So once we've understood what were our goals, and this is the most important thing, again, that has to be targeted. When I use the example of, I want to negatively gear a property, that's nice. Why do you want to do it? For tax and to provide for retirement? Well, do you know what your retirement looks like, or to provide for something else? Do you know what that looks like? Do you know what that actually means? Because if you don't, you're probably not focused enough to achieve what you are actually going to achieve, because you've also probably missed about 8 or 10 things you're wanting to do beforehand as well. So all a statement of advice is, or tailored solutions are, is strategies to make sure you achieve your goals. Now, in trying to achieve, these are wealth strategies I'm looking at now. I'll talk about protecting in the next part of this slide, but these are wealth strategies. Now, we've got three tools. I don't look at them as the assets as we went through in your current position. As a planner, I look at them as tools. I look at superannuation. Now, one of the biggest things with superannuation, as a country, we've got around about, I think it's over $3 trillion of our own money in superannuation. Most people don't understand the basics of superannuation. Superannuation in its rawest form is nothing more than a tax structure. We can invest exactly the same inside or outside of superannuation. And I will go through, I've got a slide coming up after this that shows you the differences in taxes. It is a fantastic tax structure. Superannuation is not an investment. Superannuation does not go broke. A superannuation fund may. There are different types of superannuation. There are industry funds. There are retail funds, which are all bank superannuation funds, and there are corporate funds. They are all basically multi-member ways of having money in superannuation. It's not directed towards you. They are not good or bad or whatever it might be, but it's certainly not specific to you and your goals. It is a general way of investing for those who don't want to be involved in their own superannuation. There are two options inside superannuation that allows you to invest how you want to invest. One is a self-managed superannuation fund, which has a lot of rules and regulations about it. And it is a little bit more complex and a little bit more costly, but it can certainly suit you depending on what your circumstances are. And the other option is the thing that most advisors use as an alternative to a self-managed superannuation fund, which is a lot less complex for you, but it can achieve a very similar result, is what's called a wrap account or an investment platform inside superannuation. So superannuation is nothing more than a tax structure. Don't overcomplicate it with a lot of the rules and regulations that are around it and a lot of the conversation about it. It is a lot more simpler than we understand. Superannuation, though, is for your retirement. And the reason for that is that there is really only one massive restriction in your investing. It is the money, a lot of people say it's tied up. Yes, it is. It is tied up to the age of 60 if you retire, or 65 if you're not retired. But once you hit those ages, it is fully your money. It's exactly the same as if it's in your own name. So just understand that part. The other tools we have are investments or your bank accounts. Again, if we have any goals before the age of 60, which includes retiring before the age of 60, we need to consider, have you got investments that are going to achieve that? Have you got investments that will allow you to comfortably fund your child's or your children's secondary education? Have you got an investment that in 10 years' time may allow you to have that thing called financial freedom, that from the earnings of those investments, you can go and do some overseas travel or have a bit of flexibility in your life? Or just simple bank accounts. One of the best things to save for a house is just using a bank account, again, because it comes to timeframes. And the other tool is excess cash flow. If you're spending less than you are making, you are able to accumulate to achieve any one of your goals. So it's really important to understand. That's why understanding your current position comes after your goal setting, because these are tools and they are all directed to what we're trying to achieve, not in their own right being that important to start with. Where you're starting from is not the most important thing. It's where you want to get to that's absolutely critical. Now, gearing or borrowing, what is it, and is it any value? Gearing itself is borrowing money to invest. Now, you hear all about negative gearing for properties. And the reason why people do it is to save tax. Here is a problem with that as a concept when we're trying to create wealth. Remembering there's a difference between saving tax and creating wealth. If we can do both, it's even better. If we're negative gearing, let's just use someone on $80,000 per annum. Negative gearing means you're spending on that property more than $10,000, let's say in this example, more than $10,000 than you're getting in rent. So your rent is, say, $15,000, your spending is $25,000, you're $10,000 out of pocket. Now, you can claim that on tax. It sounds really, really good. But if you're on $80,000, your tax rate is 34.5%, including Medicare levy. So from that $10,000, you get back $3,450, which means you're actually $6,550 still out of pocket. You do that over a number of years and work out what your net return on investments. Now, it doesn't matter what your investment is, property or shares. Both have got to do two things. They've got to provide a return, both capital, which is increase in value, and income, which is always forgotten in this discussion. If you're actually losing income, you've got a negative return over a long period of time. So that capital better be really good or you're going to actually lose money. So that concept, which is embedded in the Australian mindset, is really actually poor from an investment point of view. Be very clear. I'm not saying property is a poor investment. I'm sort of saying negatively gearing is a poor investment strategy. It doesn't actually maximize your return. But does gearing help us achieve what we want to achieve? The answer is yes, over a long term, because one thing we've got to be very, very clear on, when we are talking investments, we're not talking doing something 1 or 2 years. You know, people who say they trade stock, you know, stocks on the stock market and they're investing, they're not. They're traders. Traders is like sophisticated gambling. People who buy a property, do it up and flip it, that's not an investment. That's actually a business. Quite a good one if it's done well. It's like property development. It's quite a good business if it's done well. But it's not an investment. An investment is something that's held for well over 7 years, 5 years is a minimum, well over 7 years. And because you've got to give it a chance to go through a couple of cycles to grow and to smooth out any jolts in the short time. And if you want to know what a jolt looks like, think back to February, March of last year, where the markets dropped by 38% over a 5-week period. But gearing does have value. What does it have value? If, say, we have $100,000 and we wanted to make sure we had $500,000 or $400,000, let's use, in a 10-year period. If we just took the $100,000 and then each year we had $10,000 spare or let's say $12,000 spare of excess cash flow, by the time, and we've made 7%. Now, what do I use 7%? 7% is a 10%. There is a 10% 7% rule, which is this, or a 10-7 rule. If you invest your money over a 10-year period and you make 7%, you will double your money. It's actually 7.22%, but it's pretty close. If you make 10% over a 7-year period, you'll double your money. So let's say we've got our $100,000 over a 10-year period. We make 7%. We've got $200,000. We've been able to put $12,000 away each year. There's another $120,000 over that 10 years. That's $320,000 we've got, plus small earnings on that. There might be, say, $20,000 because it's not always in there. Our aim was to try and make $400,000. We come up short because we've only got $340,000. What if on day one we've got $100,000 and we borrowed another $100,000, which we use the $12,000 each year to fund and pay off that loan? Now we've got $200,000 invested. That $200,000, if we make 7% on that $200,000 over a 10-year period, we have now got our $400,000 we want. It's really important to understand gearing has a strong value, but it has to be focused towards your goals. You do not need to gear and take the additional risk of gearing and not being able to pay and losing your investments, whether it be your property or your shares, if you don't focus it towards a goal, because then we can make sure that we put as many protection mechanisms as possible. And the next question is, I will go to that one on the next slide after this one. I've spoken about in insurances and protecting and the different ways we can protect our income. Why use different investment structures? It's a pretty simple reason. Well, there's actually two reasons. One's tax, clearly, and the other one is asset protection, which I'll explain very, very shortly. All right, now let's have a bit of a look at this. We've got here personal insurances. Now, when we're working, there are a range of insurances that we can take out. Personal insurances, and I'm sure we've heard of all of these. We don't really know what they are, and we don't know whether they are or aren't important to us. But what they are, they're there to protect your income. And we need to understand their value because they are expensive and they do eat into our other goals, whatever they might be, because we've got to fund them as well. You've got to pay for them. So let's go through and have a quick look and quick discussion about the types of insurances there are. Life insurance. To be blunt, life insurance isn't important to the person who is insured. It is important to their partner and family, because life insurance on somebody is, they're no longer here. It is to make sure that their income that they would have earned over the term of their life up until, say, 65 is paid out in insurance to their family and to their partner, to make sure that they can still live the life that they wanted to live, even though that person has passed away and can no longer earn income. Total permanent disability insurance means that the person who is insured is no longer able to work. There are two kinds. There is own occupation. I suppose the best example for this one is, and I've got a client who's an optometrist. An optometrist that gets a hand injury isn't able to work as an optometrist anymore. So that type of insurance, own occupation, is really important to them. Or if you are a general labourer, or in my case, a financial planner, reality is I would need a significant event or a thing of disability to not be able to do my job. That's called any occupation. So just understand there are two very, very different types of it. Income protection insurance, probably the most misunderstood and the worst sold insurance ever in this country. First of all, my background is I used to be an accountant, and the financial planners used to come and say, when you're doing your tax returns, check if they've got income protection insurance. It's tax deductible, we'll sell them some. Not really a great value for anybody, but we need to understand what income protection insurance is. Income protection insurance protects you not for losing your job. It protects you if you are unable to work for a period of time. And what it does, and it's only through illness or injury. So you've got to either be ill or injured. And what it does is it pays usually around 75% of your wage. There is a waiting period. Generally, they run from 30 days up to 2 years. So you don't get paid in that period. That's all right, because again, each case is different, and what sort of waiting period we need, it differs from each person. And then it's paid at 75% of your wage for a period of time. It can be 2 years, 5 years, or anything up to the age of 65 or 70, depending on the insurance. So it does have some value. Now, I know I have some footballers on the line on this webinar. One of the most important things for you guys to consider is income protection insurance. Why? Because you will get your insurers with the football club insurance. You're insured for any out-of-pocket medical expenses. Your wages aren't recovered, and if you're out for a period of time, you've got an issue. Now, keep in mind, if you're a player and you've had a knee reconstruction, and on your left knee, you won't be able to get that knee insured. You can get the right knee insured, but you can't get the left knee insured. So whether it's appropriate for you needs to be properly analysed. Again, because it's tax deductible is irrelevant. Now, any one of those first three insurances, you might think, well, I haven't got the cash flow to fund them. Any one of those first three insurances I've just mentioned then can be paid through your superannuation fund. They are incidentally tax deductible to your superannuation fund, but you also pay tax on the way out. So if it's important that you and your family are covered, and one of the main reasons why you would consider it is, for example, you've got a large mortgage or a mortgage at all. And so those insurances, if something happens to you, that can get paid out pretty quickly. The only one of those that I've just mentioned can't be run for your insurance is own occupation, because there are no superannuation laws that allow the payment of that insurance to come out of superannuation. Critical illness and trauma insurance, is the least known of all insurances, yet it's the most utilised of all insurances. What does this cover? Well, it covers a majority, around about anything up to about 45 traumatic events. Now, what are traumatic events? Cancer, heart attack, stroke, short-term brain damage from an car accident, for example, that might not be covered. Some parts of it might not be covered by the Transport Accident Commission. It's a really important insurance, and it is basically statistically from the age of 30 to the age of 65, you're a 2 in 3 chance of actually utilizing it. Don't get scared by it, but you are. Why do we take out critical illness or trauma insurance? Well, again, income protection insurance is only 75% of your wage, so it's a top up for that. But here's the other one. Let's say you've had a stroke or a heart attack. The one thing you don't want to be stressed about is money. So one of the things we can cover, let's say you've got a mortgage of $400,000. Well, we might take out $550,000 critical illness or trauma insurance. You had the critical event occurs. Well, now we've just paid off our loan. Loan's gone. And we've got another $150,000 for any modifications you need to the house, any out-of-pocket medical expenses you have from the event, plus topping up your income. Gives you the good chance now to recover from that critical event. That's how we protect. The other thing is to understand if we're building up a lot of assets, estate planning. There's 2 different types. There are wills, which is who do you want to leave your money to? And if you've got a lot of money, how do you want to protect that for the people who you want to leave it to as well? And a lot of people don't realize that they actually are worth a lot more dead than what they are alive. Why? Because they might have $1.5 million of life insurance. So they think I've got next to nothing, but they've actually got $1.5 million of life insurance. And when you look at it, they've got a lot bigger estate than they believe they have. The other important thing to always consider is powers of attorney. In Victoria, we have 3. There is a financial, there is a medical, and then there is an enduring or personal thing, which is guardianship. A lot of people, particularly when they're younger, don't, and there's even some solicitors that actually think this as well, don't think it's important. Well, I've pointed out and seen this happen a lot of times. Cars or buses don't really discriminate for age. Illnesses often don't discriminate for age. So powers of attorney means simple things like something happens to you, you don't have a joint account with your partner or whatever it might be. If something happens, all of a sudden they are able to go and access your money. You might own a rental property in your own name. You've got a partner. If you're unable to act, who's actually making decisions on that rental property with tenants if you haven't got powers of attorney in place? So really understand that they are important things. Now, we as financial planners don't do these, but we do work closely with solicitors who do. So now, let's have a look at some of the wealth building structures. Let me just go back. Understand there are 4 different places in general we can own our investments. The first one is in our own name. Great. But one of the things we need to understand, we own things in our own name, there's 2 issues. One, tax, 0 to 47%. So problem there. Second one is we own it in our own name and we are sued for whatever, or do we have a dispute? Those assets are available for someone to get off you. And it might be something simple as, or it could be a separation or a divorce. So understand, owning things in own assets, incidentally, they override probably all of these 4 structures, a separation or divorce. But for things like getting sued, really in your own name, those are there for everybody to get access to. We can own it in a company. Now, there are 2 tax rates for companies. If you trade in a company, it's approximately 26%, if you're depending on the size of the company, or 30% tax rate. We can own it in a family trust. Now, family trusts are good because they do provide some levels of asset protection from people suing us to companies. However, the tax for a family trust depends on who we distribute the money to or the income to. If it's to the individual, it's whatever their tax rate is. If it's to a company, it's that tax rate again of 30% usually. Why do we use superannuation? And as I said, we can invest in exactly the same things inside superannuation as we can outside. It is pretty simple. Tax of 15% and then a great tax of 0%. And those of you who can remember the last election was fought over franking credits, the actual tax rate in superannuation retired is actually negative tax. You get refunds. That's why you put it in there. Here's the other thing. You own a commercial property. You hold it in a self-managed superannuation fund. You have greater protection of that property from getting sued for something in your business. It is now protected. So understand, superannuation is one of the best protection mechanisms, as well as for a great tax rate as well. Now, it absolutely means nothing if you go ahead and you design a plan and you don't implement any of it. Because if you don't implement your strategies, all you've got is, well, if you've gone and seen an advisor and you've got a statement of advice, you've got a nice little book that can try and balance a table that's uneven. If you don't implement it, it is absolutely crucial that you do follow through with what you're going to do, or you'll get nowhere. Here is the most important thing, and where the true value is in financial planners. The other parts, that's our expertise. That's what we know. We should be able to do it. Any competent planner should be able to do it. But you need to make sure you keep on track. We need to make sure when you're meeting with your financial planner, anyone I look after, I meet every 6 months. Why? Because things change in your life. And if we're not consistently reviewing what sounded really, really good before, might not later. So what do we need to look at? Your changing circumstances, the domestic economic environment, which is going to be interesting given the situation we're currently in now, the global economic environment that had some major implications only last year. And for those of you old enough, remember the global financial crisis? That there was another time when the global economic environment brought Australia down for a little period of time. Rules change every time, all the time. Government regulations are always changing. We need to make sure that the strategy, or you need to make sure that your strategies that you have in place are the best as per the current rules and regulations. And the only way we make sure that happens is with regular reviews. So again, and it's on the slide here, as a result, the progress of your financial position relies heavily on a regular comprehensive assessment of your position and the key indicators. At times, changes to your strategy may need to be recommended. Absolutely critical. Just a little, this is what we call in the business at Modoras, this is what we call our wheel. You're in the middle. Our purpose, our why, is to make the difference to your life so that you experience your lifestyle potential. Interestingly, as a coach, that can actually be done from a football club perspective as well. And around the wheel are all the different facets that we need to be looking at to make sure, and you need to be looking at to make sure you achieve what you're wanting to achieve. Now, I'm just going to jump out of stop share for a minute and check on some questions and go through a few before we get there. So again, if you have any questions, feel free to type them into the Q&A or the chat. I've got a couple here. The first one is, for buying a house, is it better to have 20% deposit or just jump into the market with what you have? There's no black and white answer for that one, because it depends. If you are a younger person who has a really, really good income, and you have access to being able to get a 5% loan and not pay lenders' mortgage insurance, the 20%, just understand the reason why the 20% is an important deposit. If you borrow any more than 80%, and this is a general rule, there are a couple of exceptions to this. If you borrow any more than 80% on a house, you will pay a thing called lender's mortgage insurance. It is only there for the lender. You get no value for it. In Australia, again, we've got a couple of things that are good. Depending on what you're looking at paying for your house, you might not have to pay stamp duty. But if you're borrowing more than 80%, unless you've got a particular product, you will be paying extra money just to purchase the house. So it's a cost factor. As long as you have the excess cash flow and you have access to a loan or lending that doesn't charge you the lending mortgage insurance, or it's a small number, and you still get the property stamp duty free, I don't have a problem with doing that. Trying to predict the property market is like trying to predict the share market. A lot of people say it's going to do this, it's going to do that. you buy it when you can afford it. It's more of an important thing to have a look at what your cash flow is actually like and what the security of your employment is actually like before you jump into the market. The next one is, can you provide any advice regarding superannuation, especially for women? It can be hard to understand the effect that extended maternity leave can have on superannuation and planning for the future. Absolutely. Excellent point. The most important thing with superannuation, again, is, well, its purpose. Understand what its reason is. Its reason is there to provide for your retirement. So if you don't start with the point of understanding you and your retirement, you're not going to get good advice. Probably 50% of my clients are women. And I do have a lot of single women as clients. And the most important thing is it's no different. This is the goal. What are the strategies we can do now to utilize, knowing that we had the time off for maternity leave, but this is the point we're at now. And again, planning is not about what you've got. Planning is not about what's happened or any decisions you made. You can never have made a bad decision before, because unless you've made decisions based on the information you had at the time. Unless one of you actually has a time machine that we can go back and change a few things, we can only focus on what we need to do in the future. So the most important thing is understand you when you're wanting to retire. Let's have a look at what you've got and develop strategies to make sure you hit what your ideal retirement actually is. All right, the next question. Really great question here. Is it better for me to put more money on my home loan or put money into my super? The answer is depends. All of these answers have a really simple one, which is depends. Because if you have other goals outside of retirement and super and your home loan, maybe there is another strategy that's being totally missed because we're just looking at that one particular element. If you're wanting to send your kids to private school or a Catholic school, whatever it might be, and you need some funding for that, has that already been taken care of? And we're doing some investments for that. Do you want to retire under the age of 60? If you do, well, then we need to build something. Because there is an interesting little thing at the moment. Or basically, let's say you wanted to do a $50,000 overseas holiday in 2 years' time, and then doing something like putting it in your mortgage, and so you can utilize a redraw facility is fine because you're saving 2 or 3%, and the money is actually there to utilize. But it's not necessarily the case. Putting money into superannuation is absolutely fantastic as a salary sacrifice, or don't have to salary sacrifice. We can do it each year. The laws changed quite a few years ago, so there are ways we can make tax deductible contributions into super. Why would we do that? Again, using the example of the $80,000, 34.5% tax. You put money into super, 15% tax. You've just made 19.5% on your money for doing nothing more than putting into your super. But if you're young and you're a long way off the age of 60, that excess cash flow could have been utilized for other goals as well. So it comes down to your personal circumstances and getting a clear understanding of what's important to you and your family and what you're looking at there, to make sure that the resources, those three resources I talked about earlier, your superannuations, your investments and bank accounts, and your cash flow are correctly allocated for you, not as some general concept. Keeping in mind at the moment, interest rates are fairly low on your home loans anyway. And then the most important thing with debt, I'm not too worried about debt if it's a home loan. I am if it's credit card, and certainly personal loan, high levels of interest. So yeah, we do want to get rid of those. Your home loan, as long as it's not too excessive, impacting on your cash flow, as long as it's paid off by the time of retirement, I'm happy with that as an advisor. And obviously, if it's in debt towards investments, as long as your investments are strong, again, more than happy with that sort of debt. But it's as personal, it's a circumstantial thing and a cash flow thing, and understanding what it is we're trying to achieve. Is there a value in investing outside of super? Again, I suppose, and this is an interesting thing. Fantastic questions, by the way. There's always value, but it's your value. Again, investing outside of superannuation, absolutely. If you have any goals anything. And it could be as simple as you want to provide some sort of financial freedom so you can make choices, say, at the age of 50. Now, it might not be retirement at that stage, but you want to be in a position where you can start to consider a few things. You have to invest outside of superannuation because you can't touch your superannuation money till the age of 60. Then we talk about how we invest it in the most tax effective manner. And, do we look at using gearing and all those sorts of things? But yes, there is value in investing outside of superannuation. Absolutely. But again, it depends on what you and yourself, what you are trying to actually achieve in your life. Does anyone else have any further questions or queries before I go back to the slideshow? I'll come back to questions after finishing the slideshow if you would like. Okay, so there's nothing extra at this stage. Bear with me for 2 ticks. I'll just go back to share the screen. All right, so obviously, there are some questions, and she says some nice photo of me. Had nice slick hair back in those days. Wasn't too long ago. Hair's still grey, so it can't be that old. One of the most important things is, as I said, today's presentation, obviously, is something I wanted to put on just to provide some comfort and some direction, some vision. One of the other things is Modoras are a major sponsor at West Footscray Football Club, and one of the things is if you are a member or associated with the West Footscray Football Club, you are entitled to the first meeting with me to talk about you specifically and working out what you need specifically. Doesn't cost you anything. It's just your time. Basically, come down, and there's no commitment. You're not expected to commit to anything at that stage. But it is important that we actually change the conversation around from the generalist that we look at to actually starting to focus on you and give you a bit of an understanding for you. If you do want to make a catch up with me, there is the phone number to organise an appointment. There is the email address to organise an appointment. And obviously, I'm Messenger. For those of you who are friends of mine on Facebook or contact you on Messenger or via my mobile, feel free to send me a message, private message, and we can organise a time to catch up, whether it be via Zoom or another way.
Sorry, Ian, we have a Facebook question. Can I let you know what that is, please?
Oh, absolutely.
From Kendra, the question is, with interest rates being so low, I'm hesitant to hold cash in the bank. I'm assuming I'm going to get better return by investing in the share market.
Can you just go over that one again quickly?
With interest rates being so low, I'm hesitant to hold cash in the bank.
Yep. I'm
assuming I'm going to get better return by investing in the share market.
The answer to that is obviously yes. It's not hard. Investing in the share market. And again, I think we need to understand a couple of really, really important things, whether we're investing in property or investing in shares. It's about the income that these things generate as well. And I suppose one of the things, I'll just go through, a lot of people, shares to a lot of people say they understand property, but I question whether they understand it truly from an investment point of view, but they don't understand shares, and we've never really been educated on shares. Shares is simply short for shareholdings or ownership of a business. The business is there to make money. Every business that makes money, every business that's listed on the stock exchange, whether it's in Australia or overseas, is there for one reason and one reason only, to make money for its owners, which is you, if you're owning shares. Every business has a basic rule, there's a couple of exceptions to that, where basically each year they make profits. Let's say, and they might have a rule where 50% of the profits is reinvested back into the business to grow the business, which again grows the value of that particular investment, and the other 50% is distributed out to us as income. Now, the majority of income of good quality portfolio is running at around about 4 or 5% income. Forget about growth, just on income. That's as a real minimum base. The only reason it's a little bit low on a percentage terms at the moment is because markets are quite high from a capital value point of view. And in the bank, you're going to get about 1 or 2%. If you get 1% these days, it's a miracle. So from just a conceptual point of view, absolutely, you to invest in the share market. However, understand your own circumstances. If, for example, that money is being used for a deposit on a house, markets are volatile. We can have the markets go down by 40 or 50%. But incidentally, the chances of you losing all your money on the stock market is minimal. You only lose money on the stock market investing in shares or via managed funds in shares if you panic and sell. Because otherwise, if you think about it logically, you're investing in the businesses that are employing half of the world, generate the economies of the world. So for them to go broke, as long as you're not investing in this great whiz bang, this is the best company since sliced bread, invest in that. That's the other way you lose money on shares. The economies of the world have to go. So let's understand that there is risk, but the risk is your behavior more so than the investment themselves. But let's say you wanted to buy a house and you've needed 50,000 deposit in 2 years' time. Roundabout, and let's just wind our clock back to 2020 and February. We're about 2 weeks away from getting our deposit and going to buy our house. And COVID hit. And if we all remember the panic, first of all, on the supermarket shelves with toilet paper and rice and pasta and all that clearing off the shelves and every bit of fresh food known to man. Strangely enough, we still did that after about 4 lockdowns here as well. But anyway, that's another point. Also, what happened was there's a panic on the stock market. The stock market was the most volatile it's ever been. There was 5 weeks where the market dropped by 38%. Now, you might say, yeah, but if it's an investment, it came back. Well, yeah, it has. 18 months later, it's actually 10% above the highest point just before all that happened. But you wanted to buy your house then. Well, your $50,000 just dropped down to $35,000. Can't buy your house. Also, you might have been put out of work then. Now, if you had put all of your money into the share market and didn't have a $10,000 emergency fund, for example, you haven't got it anymore because the share price just dropped and you have to sell to fund your life. So again, conceptually, absolutely, it is much better investing than having your money in the bank account. But make sure we've got our eye on everything else we're wanting to do. Really, really important that we do that. Because at the end of the day, if we don't keep our eye on ourselves, what our goals are, what our protection mechanisms are, because as well as insurances, as well as wills, powers of attorney, the other greatest protection mechanism you have is money sitting in your bank account. So it has a role, but don't expect it to do much for you other than that is its role. So if you're younger and you're wanting to save for things, probably there are better ways to get things done. I hope that answered that one for you, Kendra. Right, what have we got there? In my opinion, industry, retail, or self-managed superannuation funds? Good question. Again, it's a personal thing. Make sure we're understanding an important thing with that. Every person's different. Self-managed superannuation funds have some great strengths. They allow that direct gearing, which if you're going to run a little bit short of your retirement goal, because you want to retire on $100,000 a year or $80,000 a year, and what you've got and saving in superannuation will never get you there. Self-managed superannuation fund, providing you understand roles as trustees, can be a fantastic vehicle for you. Industry funds are good while you're younger because they're cheap and they provide cheap insurance. As you get older, the biggest problem is there is no separation of investment and cash in them. Also, you are pooled. Industry funds means that you are pooled with everybody else. So you don't get the advantages of franking credits. Also, if you're funding anything from it, like, for example, you're funding insurances, you may have to sell some of your assets that you're holding in there may have to be sold down. Some of your investments may have to be sold down to pay down your insurances. Or worse still, when you get to retirement and start paying a pension from an industry fund, you are actually selling down your assets to fund your retirement. So if something happens like the global financial crisis, or in particular where the markets were down for 3 or 4 years, yeah, they can be a bit risky. And they don't. And the most important thing is they don't allow really good quality bespoke investments. Retail funds, they're a more expensive version of industry funds, and that's why every time you look at the ads from the industry funds, they'll always do the comparison against retail funds because it's not too hard to do. More expensive earnings. It's an interesting thing. I had a client ask about this today. They're asking about, because again, as an advisor, instead of using a self-managed superannuation fund, I use a thing called a wrap platform, which allows us to actually invest in whatever in what we would like to invest in. At our business at Modoras, we have a fantastically qualified, in fact, and I'm not actually just saying this, one of the world's best investment committees that puts together our portfolios for us. And I know that they're going to have really good returns on their investments. Just understanding that we can actually get a much stronger return from different entities, whereas with an industry fund, you just don't get that. It just doesn't happen. And the other thing to consider too, if you're young, you don't have a lot of money in superannuation, you don't have a lot of cash flow, industry funds are absolutely perfectly fine. Here's another simple thing too. If you are in the building industry, there are a lot of sites, union sites, where you can't get on if you don't have CBUS. So there are circumstances that we have to have them anyway. There are ways of having them and having something else, but understand again, superannuation is there for your retirement. Is it the most appropriate vehicle that you're utilizing? Self-managed superannuation funds, if you haven't got at least $300,000, even though the law says 200,000, you waste your money. But over 300,000, absolutely fantastic if they are right for you. And just to go back on that question about cash and shares as well, there's a really important thing to understand. Inflation now is higher than your interest rates you're getting on term deposits. What does that mean? It actually means you're putting money in a bank account to have less spending value later, and it's called investing. And the simplest way to put that, imagine what you could have bought with $10,000 10 years ago and what you can buy with $10,000 now. And if your interest is not even keeping up with inflation, geez, what a poor place to have your money for investment. Protection, it's got a role. And as I said, its short-term role is there, but for long-term investment, it is a really, really poor option. Any further queries at this stage? Okay. I will just finish this next little bit and then we'll see if there's any queries to go.
Quick review, Ian. Looks like we have covered everything. But right now, I think we have your information. So let me see. Let me just pull up the slide here.
Okay, so if you could just take over now and let me just get rid of that. Hold on, here we go. And if we have any more queries or questions in between, feel free to ask before we wind up.
Just a few reminders to our attendees as well. The video recording will be available on the West Footscray Roosters Facebook page, as well as Modoras Facebook page. Everyone attending this webinar on Zoom, you will also be receiving a recording. So please feel free to share this wealth of information from Ian today so that we can help protect how we can plan and protect what's important to you.
All right. Thank you very much again. And again, thank you very much for Stella, Elaine, and Emily for helping me put this together. Thank you very much too for your time. I know quite a few of us have a fair bit of it at the moment. The most important thing, and the way I look at financial planning, is pretty simple. It's about investing in yourself. At the end of the day, you're the ones that are working hard. You're the ones that are taking the risks. You're the ones that are doing it. It's yours. Why not invest a bit of time in yourself to make sure and spend some time each year to make sure that what you're doing is actually working hard for you as well. So thank you very much for your time. Really appreciate the fact that you got along, and hope everyone got something from it. Thank you.
Thank you, West Footscray Football Club's Roosters and friends for joining us at Planning and Protecting Your Future webinar. Let us talk more about your future. Leave us a comment, message, or email us. We look forward to talking about how we can plan and protect what's important to you. Have a good night.